Are you looking for a safe way to grow your savings? Something better than a regular savings account, but without the challenges of riskier investments. Today, we're diving into certificates of deposit, or CDs, a simple but pivotal tool in your financial toolkit and a great way to earn and secure a predictable amount of interest over a set period of time. Stay tuned, because by the end of this video, you'll know just about everything needed to begin utilizing CDs as an option in your savings arsenal. So as they say, time is money, so let's get moving. Hey everyone! This is AJ, your ace in the hole, and welcome to the channel where we super simplify personal finance, providing tips and life hacks for young adults and others based on real-life experiences to help kickstart their financial journey. Whether you're just getting started or a parent looking for some ideas, either way, I'm here to help stack the deck in your favor. So let's get down to business. We'll start things off with the basics of a CD, how they work, as well as benefits, limitations, and risks. We'll then talk about opening a CD account and the things to consider, and I'll even touch on some advanced strategies used with CD investing, such as CD laddering. And then we'll finish up with a summary of when CDs make sense and when they may not. Once we cover all those details, I'll even provide a personal view on how I incorporated CDs into my savings plans over the years, which may provide a real-world perspective on their use. First off, what is a CD? A CD, or a certificate of deposit, is a low-risk saving option offered by banks, credit unions, or even brokerages. You agree to deposit a certain amount of money for a fixed period of time, and in return, the bank pays you interest. Once the term ends, which is called the maturity date, you get your original deposit back plus all the earned interest. Think of it like a locked savings account. Typically, people use CDs to earn more interest than a regular savings account without having to place their money into riskier investments, such as the stock market. It's a great option for savings goals, parking extra cash, or supplementing other investments. Now, here's how they work. CDs are available in various terms of maturity, which you choose at purchase, typically shorter terms at 3, 6, or 9 months, and longer terms at 1, 2, or 5 year, even up to 10 years. Normally, the longer the term, the higher the interest rate, but not always. Rates are driven by market fluctuations and economic conditions, and there can be times where shorter term rates are actually higher than longer term. You may hear this referred to as an inverted yield curve. Either way, once you lock in, your money sits earning a fixed rate until maturity. But there is a slight catch. If you withdraw your money early, you'll likely pay a penalty, so it's important to only commit money you know you won't need to access during the term. Since we touched on interest rates, let's dive a little bit into this topic, as it will be important to understand before choosing a CD. As mentioned earlier, CD interest rates are influenced by the economy and market conditions. When the Federal Reserve, or the Fed, raises rates, CD rates usually go up as well. The same occurs when interest rates are lowered. So the timing of your CD purchase can matter. If rates are expected to rise, shorter-term CDs may be better to keep your options open. If rates are projected to drop, longer-term CDs may be wiser to lock in at the higher rate. Now you're probably thinking, how do I know where interest rates are headed? Great question. Unfortunately, we don't really know for sure, since it all depends on ever-changing economic conditions, but I can give you a handy tip that can at least provide some insight. The CME Group FEDWATCH tool tracks and forecasts the probability of changes to the federal target interest rate. I've been monitoring this tool for years now, and it's never been wrong. So if you're curious, I'll link the FEDWATCH tool in the description below, and if you have any questions, just leave them in the comment section. Now, not all CDs are created equal. Here are some of the different types with a brief description. So first, traditional CDs. These are the most common: fixed terms, fixed rates, and penalties for early withdrawal. High-yield CDs, also popular, are offered by online banks and can have slightly better rates, similar to online high-yield savings accounts. No penalty CDs let you withdraw early without a penalty, but usually offer lower rates. Bump-up CDs allow a one-time rate increase if interest rates happen to go up during the term. Variable rate or flex CDs can fluctuate with interest rates over the full term, but can also go lower, therefore come with added risk. Jumbo CDs have much higher deposit minimums, often $100,000 to start, but can have slightly better rates. And finally, brokered CDs. These are purchased through brokerage firms, and while a little more flexible, can be more complex. They might offer slightly higher interest rates, but also higher fees. Each CD type has pros and cons, so choose based on your needs and risk tolerance. On a side note, my personal favorite is the high-yield CDs. Next, we'll get into the benefits, limitations, and risks of CDs. But first, a quick mention on how to open a CD account, which is really quite simple. Opening a CD is all about selecting the term length and type of CD that fits your personal situation. From there, most CD accounts can be opened in a few minutes online. To start, shop around. Compare interest rates, choose a term length based on your financial goals, and assess minimum deposit requirements. Also understand the compounding interest frequency. Most CDs compound monthly, meaning they pay out interest each month, but some may compound annually or semi-annually. Also, many CDs allow you to either reinvest the interest within the account or may allow you to transfer earnings outside of the CD. A quick tip: you should always leave your earnings within the CD so that it can build even faster through compounding. Also be aware the APY rate, or annual percentage yield, includes the effective compounding interest, while the interest rate does not. You may see both listed when shopping CD rates. Also be sure to read the fine print to understand any fees and early withdrawal penalties. Finally, when you're ready, fund the CD, usually by transferring money from a checking or savings account. I'll post a couple of links below to a few banks that historically have offered higher CD rates. Now, on to the benefits. So why choose a CD at all? Well, there are a couple of reasons. First is the guaranteed income. You know exactly how much you'll earn and for how long. Next, CDs are FDIC insured. The FDIC, or Federal Deposit Insurance Corporation, is a U.S. government agency that provides deposit insurance up to $250,000 per depositor per bank to protect you against the loss of money in the event of a bank failure. One quick note: the FDIC has never failed to cover a valid claim since its establishment in 1933. This is what makes CDs such low risk and one of the safest options available. And then finally, it helps you avoid spending since your money's locked in. Now, there are some limitations and risks associated with CDs. First, your money is illiquid, meaning you can't touch it easily, as opposed to general savings accounts, which you can access at will. Next are those early withdrawal penalties. You need to be sure you can commit to the term and the amount you plan to contribute. CD returns might not keep up with inflation. For example, if your CD is locked at 3% but inflation rises to 4%, your earnings may not be keeping pace. And finally, in a rising rate environment, your money might be stuck earning less than newer CDs that offer higher rates. Now, clearly, the main downside to using CDs is the fact that you lock up your money for a period of time. And for many, this might not be very comforting. However, there's a perfect solution to combat this very thing, using a very popular advanced strategy. So, if you want to participate in CDs and keep some access to your money, try CD laddering. CD laddering is a strategy in which you stack multiple CDs. There are a few forms of CD laddering you might consider. The option you choose may depend on a couple of factors, such as current interest rates, the potential for near-term interest rate moves up or down, and your financial flexibility. Here's the basics. Simply put, instead of putting all your money into a single CD, you split it across multiple term CDs. For example, let's assume you want to purchase a single $10,000 CD for a 5-year term at 4.5%. Instead, you purchase 5 separate $2,000 CDs in varying 1 to 5-year terms. You'd purchase a $2,000 CD for a 1-year term at, say, 3.5%, another $2,000 CD in a 2-year at 3.75%, $2,000 in a 3-year term at 4%, another $2,000 in a 4-year at 4.25%, and your final $2,000 in a 5-year term at 4.5%. Now, when the first 1-year CD matures, you reinvest that into a new 5-year CD at 4.5%, which will now mature in year 6. As each CD matures, you reinvest that money into a new 5-year CD. Eventually, you'll have one CD maturing every year instead of locking up the full $10,000 for a full 5 years. You can even use this strategy for shorter terms, such as a 3, 6, 9, and 12-month ladder, or other variations. CD ladders are great for balancing return and flexibility. Now, with everything good in life, there's taxes. CD interest is considered income, and yes, it's taxable even if you don't withdraw it. At the end of the year, you'll receive a 1099 INT tax form from your banking institution, reporting the interest earned to file with your next tax return. There are options to defer taxes by purchasing CDs within an IRA or an individual retirement account, or even avoid taxes overall by purchasing CDs within a Roth IRA. We'll be covering these types of accounts in future videos, so be sure to subscribe so you don't miss those. Now let's talk about when CDs make sense and when they may not. CDs might make perfect sense if you want a guaranteed return, you won't need the money during the term, you're risk adverse or nearing retirement, or you're saving for a short or medium term goal. However, CDs may not make sense if you're chasing high growth, are needing quick access to your funds, investing in a high inflation environment, or CD rates are just unreasonably low. Now, regarding me personally, I have always had some form of CDs in place, even as a young adult. I just keep an eye on interest rates and throttle CD purchases accordingly. When interest rates are really low, I might only have one CD, or even none if rates are really low, reallocating savings to other higher return options during that time. However, if interest rates are at a reasonable or increasing level, then I hop on the CD bandwagon, typically but not always using some form of CD laddering. CDs have always held a place in my savings strategy to help provide a safe, secure base to my overall financial portfolio. So let's recap. CDs are a safe, secure, and stable way to grow your money. They're easy to understand, perfect for conservative investors, and can be optimized with advanced strategies like CD laddering. Have you used CDs before, or are you considering trying them out? Drop any questions in the comments, as I'd love to help. In future videos, we're going to cover many other investment options from safe to high risk that can all be used in conjunction with CDs. So be sure to like and subscribe so you don't miss out on those. And most importantly, if you know anyone that might be interested in this type of content, please share the video. It's our goal to help educate our future generations with the info they need to build their own financial success. Now, if you're interested in just how powerful your CDs can become over time, check out our previous video here explaining the sheer power of compounding interest. And I hope you join me again in our next video. Until then, this is AJ, your ace in the hole. See ya.